tonight. So I don't know where we're gonna sit.
I think so. We saw the empty seats. I think we could probably just put.
And I just would sit in the back and.
Yeah.
Okay, we're live.
But we're not sitting in the front.
Welcome.
All of this is. I don't know where the table will be or who's moving tables,
Not gonna be there.
but we will go in for our caucus. The word is that Tom Cavett is on the way. Randy has distributed an email he's going to send on our behalf asking Karen if there are any business arrangements with any former employers. And once we get that answer, which I'm assuming will be quickly, we can make a decision tomorrow at the end of the day. We will get that in. I'm going to, tomorrow when we finish with property valuation overview, I'm going to schedule in just a debrief so we can, once we've gotten a night's sleep and had a chance to wrap our head around this proposal, which from everything I've heard and seen is going to be very comprehensive. We can discuss that. If we can get somebody from the administration, I know Joint Fiscal has been working to try and understand what the proposal is and to understand things, questions we may have, so that they are in a position to help us sort it out, crunch other numbers, and work our way through it.
Should we have, we're still on pause?
So we have,
We're live, but we're not.
we are live, we're waiting for Tom Cavett.
Okay, thank you for leaving.
We're waiting.
The word says he's on his way, and I thought he was only in room 9, but.
This is dangerous. Can we move this closer to Scott and Randy?
We're still early. We're still early.
I meant to tell the
My
committee,
impression.
there's a basket back there that is welcome to snacks for those that are selected and employed to be here. Where's the basket snack? There's a basket here. Put it out here, then it just disappeared
Too much.
quickly.
Yeah.
I was a little fast.
Welcome.
Hi, sorry to be late. We're doing a joint Senate House appropriations, and so there were more questions for more people.
Well, fewer people,
Sure.
hopefully fewer questions, because we have to leave at,
Wait, 45?
yeah, maybe even a couple minutes before that, so. we
The big
can-
reveal party.
You got about a half.
A real party, you know.
Reveal.
Oh, reveal party, okay.
Yeah.
Have a big reveal.
The big reveal.
So we will at least get the broad outlines of what the proposal is, for financing and delivery structure. And then we know what we have to start working. Okay.
And,
Welcome.
and did everybody see the e-board presentation, or is that,
It's on there on our iPads. And
but wasn't necessarily?
no,
like,
but they
because-
were in other committees this morning.
Yeah, okay, some of the other ones,
Yeah, the House
We're
members can
asked.
watch it, you can't.
okay. So I want
Maybe we
to,
can
Well
just
said.
do it so in the, next year it's in the afternoon, so.
yeah, because the question and answer, yeah, that's not a bad idea, because the question and answer that we had with Ways and Means and some others where they had watched it was really good. And we didn't have to like go over like, oh, here's the overview and all that kind of thing. But people could sort of think about it and see what was asked at the e-board. This e-board meeting too was more fulsome than most. They were,
Yes.
it was sort of, there was more back and forth and bigger part of the report was covered. Sometimes it's quicker and
I can't ever remember asking about the back of taxes or childcare payments.
yeah, right. So anyway, all right, so I'll give a kind of a quick overview and then see if there are questions and however you want to handle it.
Does anyone want a hard copy?
I'm sure they e-board things online.
Is it an extra?
No.
You mean the document?
Thank you.
Oh, yeah.
So, yeah, I'll take one.
You got one, that's fine. You got a hard copy, sure.
Yeah.
I'll take that one because I gave mine away.
You like it?
Thank you. I do love all these graphs.
Yeah.
But there's no
Do you need
cartoon
this?
stuff.
Sure.
Yeah.
I know. They're like, well, we're our copy, all I know.
There's no cartoons.
Oh.
That was the highlight.
I know.
Oh,
You
it's
got-
The
you got-
graphs are the highlight.
No, it's the politically correct censors that like
Oh,
totally killed the cartoons. It's-
Oh,
Nobody
okay.
has a sense of humor anymore. It's,
this
you
is
know, it's
true.
gonna offend somebody no matter what. And it's like, okay.
I think we should just make it knows that we're offended because there are no cartoons. That's the best part of the report.
What do you tell leadership? It's, no, you're right. It's like the New Yorker magazines. Where do you go to? You open, you look at the cartoons. That's the best part of
You
it.
could include a word next time.
Yeah, that's another thing on the whole thing. Yeah. No, you know, because just in looking at other press and stuff like that, sometimes I'll see a cartoon and I say, oh, that's hilarious. That's really good. And, you know, they're not meant to be offensive. They're funny. And, anyway, that was at some point, somebody was just too
We'll
sensitive.
have to put something on the record in terms of the committee's concerned.
Did you want-
They added true value.
I could do a version. In fact, I've, there are two transportation committees tomorrow that I'm talking before. I haven't always done transportation committees separately, but when Rich Westman was head of the House Transportation Committee way back, he and I would sometimes ski together, and he wanted, you know, his committee to get a presentation too. So he said, fine,
He's
come
here.
in and we do that. Now he's in transportation here and he wants to have it also. But anyway, there were a few charts that are background charts for transportation that are different than this, kind of go in more depth. And I thought I could throw in a cartoon on that one. Nobody's going to be offended by something about gas prices. But yeah, it's too bad of the cartoons
On our
anyway.
gas prices, I got gas for $2.75 at Cumberland Farms in Maine. Now, I know it's cheaper in New Hampshire because they don't have our gas tax, but we've always been pretty equal with Maine. They are good 10 cents cheaper than we are.
That's interesting.
know
So
why.
their ports or whatever, is there.
It'd be Portsmouth, I think, is the big.
So they're closer to the
Yeah.
water, or at least their big markets are closer to the water, so maybe they get.
That's it, but they always were pretty close to us, but there's been a divergence recently.
Yeah, yeah,
New
well-
Hampshire's the outlier.
yeah, yeah. Well, lower gas prices, than we were carrying in the last forecast do account for, some of the softness in the gasoline receipts and certainly the TIB, which just has sort of a, you know, price thing. So it's, we try to hedge bets by having motor fuel assessment be price and the other gas tax per gallon. But when both are going down, you're not going to win. But the consumer wins because gas prices are cheaper and the economy generally wins because we don't produce gas. We just consume it. So those are dollars we keep. If we had gas producers, then weaker gas prices would be a problem. It's actually something too that, the incoming administration in Washington is talking about raising production by 3 million gallons, a day, I think is the net rate. Yeah. That would push prices down even more. I don't know why any producer would be wanting to do that.
Right.
So I think that's, the Commerce Secretary, incoming Commerce Secretary is this 3-3-3 plan, which is 3 more million gallons of, no, must be barrels a year. Yeah, that's my problem. 3% real GDP growth which is also a tall order, but we are just about there this year. So the fourth quarter tracking on real GDP is a little over 3%. And that would put the year as a whole just a little bit under 3%. And that's extraordinary. Not easy to replicate. So anyway, just broad overview of revenue situation and why we're recommending what we recommended. The first page, first two paragraphs are written so that if you don't read anything else, you read that and you'll have an idea of what's happening and where it's going. And a lot of times people don't read for that. That's fine. Without cartoons, I can't blame them. So, but basically, the economy is doing really well by any aggregate measure. There's a lot that's below the aggregate level that can be problematic, and there are a lot of examples of that in this document. But when you just look at overall growth, as I said, is up around 3%. There have been 48 consecutive months of employment growth. The unemployment rate's at 4.1%. Inflation is down to 2.4% on a PCE basis, which is what the Fed uses, when it's trying to get to its target. It's still a little above the target, but it was close enough that they felt like they could start lowering interest rates, and they cut, starting in September, 100 basis points off the federal funds target. So, productivity has been absolutely extraordinary. That kind of productivity growth is rare. It's just like any metric like that you look at is basically quite good in aggregate. Stock market hit multiple record highs throughout the year. It's up 26.7% for the year. It's just like, you get a whole lot of things that look very good. And that's resulted in a little bit more revenue than we expected. And so if you go to page 14, at the bottom of page 14 is kind of the bottom line of what we're forecasting with revenues. So this table is the change by major fund between this forecast and the last one in July. So it's, how much more money we'll be getting or less money, depending on the fund and year, than was expected 6 months ago. And overall, they're fairly modest adjustments, like 1.8% across all the funds in 25, 1.4 in 26, 1.0, 0.5, and just about even in 2029. So fairly minor adjustments, but $60.4 million in fiscal 2025 is, not insubstantial.
Just let me ask you a question. In terms of, this is a percentage change year over year in terms of revenues.
No,
Correct?
no.
No. All right. What am I looking
This is
at?
the change relative to the July number. So you take the July
okay.
number,
All right.
you said, oh, we're adding 60.4 million.
Mhm.
That's a 1.8% increase
Mhm.
to what was forecast back in July. So
Okay.
that's not seismic,
They're changes to an estimate.
It's changes to the
They're
prior.
not changing to an actual.
And so if we want to look at this as a measure of, call it inflation of these particular funds year over year, we would look at a different number. We would start with what we had and then add to it the amount of that percentage on a year basis.
Yeah, so let's go to page, like the tables. Let's go to page, I think the 5-year tables are on page 50. Start on page 50. So those show you, if you have good glasses, they show you all the levels by the various funds each year and the percent change over the previous year. That includes all the new taxes and all the new allocation schemes and all that kind of stuff. And the source general fund is just the is the broadest measure. So something like meals and rooms peels off. Some of it goes to general fund, some of it goes to education fund. We don't forecast those separately. We look at the economics behind what drives overall meals and rooms and then just apply those percentages to that. That's why we show the source forecast is a better one for getting a sense of it. But what gets voted on in the emergency board is the next page, the available general fund. And then there's a healthcare breakout, transportation fund, same way. There's a source and an available education fund derives entirely from the source numbers. So that's that doesn't have a separate source figure.
Well, I remember what
That-
David said in December.
Yeah.
Was that what we can anticipate looking forward based on, I think it was based on a 2.6% inflation adjust from the prior year. The prior year was 2.6% up until that point when you gave us a presentation of those numbers in December. And what you had said we should anticipate is that our revenues would be relatively flat. However, our expenses would tend to grow over the next several years. That was the takeaway that I came from that presentation.
Well, no, I mean, with all the new taxes, revenues are growing in some areas dramatically. And most of them have growth, base growth happening now, widely varying levels of growth. But and we're not involved in forecasting expenditures, really analyzing expenditures at all.
Okay.
There are times we make comments about things like the COVID and infrastructure money buying a lot less than we thought it would just because of inflation. So we're looking at inflation as a separate issue. It affects a lot of revenue sources. Now that it's at a lower rate, it's not as big a part of the story. So as you look at these going forward, your real growth rate is not too far off what the nominal is in some cases. But, the big increases, are mostly tax changes in the near 25, 26, even some of the out years. There's a lot of growth that's coming from new taxes. Now, that said, a lot of the new taxes in fiscal 2025 have not yielded as much as we thought. Property transfer taxes yielded more, but it's not clear that's where it's coming from the new tax or whether it's coming from less of a decline in the base. With interest rates high, property transfer activity, we expect it to actually be lower in 25 than in 24. And it looks, well, it's going to be higher because of the new tax, but quite a bit higher. And it's possible the base actually wouldn't have declined absent the tax, but we won't know that without more analysis. You had a question?
That was the topic of my question. So I'm looking at page 14 and for your adjusted or reduced revenue outlook for the education fund. I remember in December at that presentation, you said it was because the short-term rentals tax and the cloud tax seemed to have taken in less than anticipated. I wanted to know if that has been adjusted at all. And also, how much did you factor in market orientation to those downgraded estimates? Was it partly that the Airbnbs were paying because they didn't know they had to pay, or that the reservations were booked prior to it coming into effect? And do you hold out that it's possible some of those revenues won't be as downgraded as much as we get a full year's worth of revenue collection data?
Yeah, that's possible. With every new tax, there are, issues. Rarely is it just clean, like, occasionally you'll get something, there's a tax that's been collected forever and you have a really good source of it, so the payers are fairly sophisticated, so they know when there's an increase and they all comply, like cigarette and tobacco products. They're very, fairly small number of payers actually, and they get the rate thing and that's what they pay. You can estimate a change there with a fair amount of precision. You still have market responses to changes in prices. So there's a little bit of what's called elasticity adjustment that you raise the price of something and then there's less demand. If something's really inelastic, it doesn't drop very much at all. If it's highly elastic, a price increase can drop it substantially. So that sort of thing exists with it's all over the map with these new taxes as to which ones are easy and which ones are not. But a lot of these are not easy ones. They're in new areas. So take the cloud tax. You might be dealing with people that aren't paying any sales tax of any kind. And this is the first time they're doing it. And they don't know that all of a sudden Vermont, teeny little state over here, has decided they want us to, want to ding us for this amount. At some point, especially if it's a big enough firm, the professional tax preparers and accountants and tax lawyers and all the rest will figure out they owe it. They might even do a true up and pay you back taxes on it. They might not. They might just start paying and say, if they contact us, we'll correct it, but we just found out, so we're just paying now. All that's happened in the past, both of those things.
And I think we found out that the cloud tax was quite complicated. I'm not sure any of us felt really comfortable when we get out of here at 10 o'clock at night that we knew what we were taxing.
Well, see,
So
if you're uncomfortable.
Yeah, I'm anticipating that we will have at least the tax department and joint fiscal give us an update because the surcharge and Airbnbs was.
Well, we have that data too,
Yeah.
that we can separate.
Yeah.
So we've been tracking short-term rentals anyway, because that was a big part of Meals and Rooms growth and through the pandemic and all these huge swings and all the rest. And we look at that by individual payer and, look at it as a share and all the rest of it, So that one we have a pretty good idea on. That's light, but we know it's light. And with the timing, the question about the timing, that's a little bit of an issue, but we also expected that. So we had that baked in and it's behind that estimate. So that market is kind of flattened off a bit. That is not, it started out, it was an incredible growth trajectory, supercharged around and after the pandemic. Then it kind of dipped and its growth rate has been flatter than we would have expected. And also fairly disparate within the universe of companies that are doing this. Everybody knows about Airbnb, but there are a lot of other players too that are in the mix. Compliance looks like it's been good because we can see the short-term rental tax paid by payer. And that looks to be good. So that doesn't seem to be a problem. It's just a question of volume. And so that one, we did downgrade that a little bit. And that's part of, these estimates. The cloud one's much harder because we don't know all the people who should be paying that or how much they should be paying.
Yeah.
We don't have a breakout on any tax return that they file of, because this is sales and use, not corporate income.
Right.
And so we can tell from a corporate return, oh, they're in this business, but you have to know a lot about their business. Does it really fit or not? And it would be tough tax probably, they can contact the people they think are big players or should be big payers in that, and have conversations with them. But I don't know how far down they can go, because it's a hard one to figure out. I imagine it's the kind of thing that over time, the tax professionals that work with these entities will say, yeah, you do owe this. You haven't been paying it for 3 years, but you do owe this, and start paying. That's kind of how we phased it in. So over 5 years, it's pretty close to the estimate, but a much slower phase in now. And that's a big part of why that comes a little bit lower.
We're gonna do just a look at how it's going in. Are there problems? I don't trust anything we do after 7 o'clock at night to be perfect. And I think we need to go back and just make sure that we got the wording correctly so that we aren't making it more confusing than it should be.
Yeah, I mean, there are other states that have done this, but we
Yeah.
looked at other state data on it. But, yeah, so there, there should be language that are triggers for the people that
Right.
are trying to figure that out.
We will.
But they might have, yeah.
Yeah.
Might have missed something. Well, I'll be interested to hear what you out because that'll affect the next forecast. And of course, we're in contact with tax all the time. The childcare thing is another really big one. But that's kind of a different issue. So there are compliance issues with that. Most likely, but there are also timing issues with the way we're accounting for it. And that's going to take a long time for all that to up. So first quarter was due, end of October. And there were payments made, but they're 5 million less than what we thought should have been paid. And we're kind of deducting that from the general funds fund. The good news on that is that at the end of the year, it's short, you'll be over in the general fund the same amount that whatever should have been paid is under. It'll still be a political decision to move things around, but there'll be money.
Wait, why will there be extra in the general fund as opposed to?
So right now, personal income withholding tax is where payroll taxes basically land in the Schedule 2 reporting the tax. And so we assumed that there'd be a liability for, there and use tax department data to identify what we thought, was the right percentage and the right coverage and who had liability and who didn't.
Mhm.
And we had a theoretical deduction from that we would, carry and only report what we thought, the withholding amount minus that theoretical deduction.
Got it.
So, so that money's there. Maybe if it's truly not a liability, then it's woefully underestimated. There's a funding issue. But the good news is there's more money than expected in personal income withholding because it didn't get paid out.
Yeah, okay.
And we haven't changed the estimate based on what happened in the first quarter. But it's gonna take quite a while, I think, for that to get straightened out. And-
Okay, we've only got about 8 minutes.
all right, well, questions.
Anything
then?
we need to basically the economy and the state as a whole is doing well. We've got a little extra revenue, but over July, but nothing, not a lot. We're gonna get an ed fund update with Julia because we got one this morning. When we went home, we had used $70 million in one-time money transferred from the general fund. And for a variety of reasons, we are not starting out $70 million in the hole this year. I think it was expenditures did not go out at the level we thought they would. Some of the budgets came in lower than we estimated because they came in after we set rates.
Right.
So it's better than it could have been, but
Mhm.
it's not bringing in the money we had hoped for, the sales taxes. There's no federal stimulus there, and despite in this morning, we had quite a discussion about if you have assets, especially in the stock market, this economy's doing real well. If you don't, and you're living on a salary, you're trying to buy a house or you're paying rent that's inflating. Every time I go to the grocery store, nothing comes down. So at that level, and that's a good portion of Vermont, you're not doing that well.
Yeah.
And after the report from the Green Mountain Care Board, I don't even want to think about healthcare, but we are going to have to. Because we're seeing the same trends that we saw in education. All of which is just adding to the ability of people to move here, stay here, or to survive here with any fiscal comfort. So
Yeah.
It's going to be an interesting.
Economy's doing great. I worry very that it's a bubble.
I think there are a lot of potential bubbles, you know, when you look at that stock market chart. You know, if you were investing now, how much more do you think you're going to get? You look at housing,
Yeah.
it's like at some point, housing has to link up with income because it's,
Right.
you know, people are buying houses to live in that it can't
Yeah.
go somewhere. And housing has been very, very cyclical, you know, I mean, you look at
Yeah.
some of the charts on that. And it's just both of those, I think, and that's what we're forecasting on.
Yeah.
I mean, not that the stock market is something we're forecasting, but this is the year over year change in Vermont
Prices.
housing. Yeah, so that's like, you know, residential. But you see these big periods where prices will run up, you know, and usually it's because there was a crash and then for an extended period, nothing gets built because all the contractors and everybody lost their shirts the last time around. And then it gets behind, prices start to go up and
Interest rates go down.
it takes so much time to get land, to get permits, to get the things built and, you know, all the rest. By that time, things can change. So then it, you know, for a while it's euphoric and then it crashes again.
So
So here's where we are.
If we fix the way we're thinking right now about speeding up the building of houses,
Yeah, that's
these crashes would be a lot closer.
it's all to the, and actually, yeah, yeah. No, you're absolutely right.
Cyclical.
It's, you know, the only good thing you can say about a long permitting process, it definitely discourages overall housing.
Mhm.
But you have a longer time if the market does turn to bail without having a whole lot of money into it. You know, once you have something half built,
Yeah.
you're gonna finish it or you're really lost.
No, you really are.
Yeah, right. But, yeah, I think there are a couple potential bubbles like that. I mean, elevated asset prices are behind a lot of the strength in personal income, corporate, and certainly estate taxes. And those are three of the strongest performers. So if asset prices do get deflated, that'll have knock-on effects to other
Yeah.
sources of revenue and some of the strongest ones. It also makes all three of those categories even lumpier than they already are, more volatile.
Yeah.
Because you can have these really big events and, you know, clearly somebody's getting a lot of benefit out of it because the tax payment's only a teeny part of whatever the gain is, but still, you know, it's kind of on and off and on and off and difficult to forecast. I mean, ideally you have some kind of confidence in a revenue flow.
Okay. Do we have other questions?
If other things come up, feel free to contact.
We will.
me after.
I'm sure we work through. Questions will come up.
Yeah,
Fortunately, we don't have to do the budget.
right.
We just do
That's
the ed
fun.
fund.
Easy.
Yeah, so anyway, committee, we've got 5 minutes to get upstairs and find out where they put our table or not. And, I'm not gonna have us come back because I think it's gonna be after 5 before we get out of there without question.
Yeah.
I would suggest we not like.
Not allowed.
The one.
It's gonna be so hard.